So you're thinking about buying a house here in Denver, in Boulder, in Colorado in general, but you're curious if you will qualify for a mortgage. More on that later, but stick around. This video hopefully has everything you need to get started. How's it going, my friends? My name is Jesse Lynch. I run the hardest working real estate team in the game. We're called Welcome to Denver. You can check out our website, welcometodenver.co. But this YouTube channel is all about helping you find a place to call home here in Denver, Boulder, whatever, the Front Range of Colorado in general. And that's whether you're buying a house here for the first time, just a first-time home buyer, or if you're moving here from, out of state, across the country, I guess across the state, or even a totally different country. Whatever it is, we got you, and we are very happy to help. So if either of those things appeal to you, do us all a favor. Subscribe to this channel, click the bell to get notified, give the video a thumbs up, and say what's up in the comments. I would appreciate it very, very much. And if you're thinking about moving here to beautiful Denver, Colorado, do whatever you can to get a hold of us. You can go to our website, welcometodenver.co. We have blog versions of a bunch of our videos on there. We also have a contact form, super easy to fill out. Just, give us some information, tell us to give you a shout, and we will give you a shout. That's super slick. You can also email us at info@welcometodenver.co. Make sure it's CO, not com. I don't even know if that would be an email, but info@welcometodenver.co, as in Colorado. Or you can call or text the number on the screen. They'll lead to me, they'll lead to us, and excited to hear from you very, very much. Today's video, we are talking, can you get qualified for a mortgage? What does it take? How do you figure that out? Part of this is just because I know that some people just have anxiety about reaching out and having no idea if they're even close to being able to qualify for a loan. So I feel like if you're watching these videos and that is something that's kind of holding you up, then potentially this can be something that just sort of pushes you, on to that next little step of reaching out to us. But either way, I hope it's helpful, and let's get into it, huh? First of all, one thing that I want to explain, it's not really going to hinder anything about you getting a mortgage or anything like that, but just one thing to know, and I'm saying it, I'm guilty of what I'm about to talk about, but when you say, I'm going to get a mortgage, or can I get a mortgage, it's not really how it works. Technically, when you buy a house, you get a loan for a mortgage. You're giving the bank or the people loaning you the money a mortgage that says, hey, I bought this house, you help me pay for it, I promise I'll pay it back. I'll give you this mortgage, and then you give me money. So everybody thinks about it kind of backwards. You think that you ask a bank for a mortgage. That's not really how it works. It's actually the other way around. You ask the bank for a loan to buy a home, and then you give them a mortgage as a sort of collateral on that loan, if that makes sense. That said, I'm not a total snob. We're not going to chastise you if you say something like that. But I don't know, just for your education, that's kind of an interesting thing that basically nobody realizes, is that's kind of a backwards way of thinking about it. But whatever, not a big deal. Second, a little bit of housekeeping. I am not a mortgage broker. I'm not a finance professional. This is not financial advice, so please don't take it as such. I'm probably 1,000 times during this video, I'm going to say you should probably talk to a lender, right? to get a little more clarity on these things. And that's because I'm not a lender. I run a real estate team. And so just putting that out here first, this is not financial advice. Okay, so just throwing it out there, this is not financial advice. This is just stuff that I've encountered along the way in my real estate career. And in fairness, I did talk to our preferred lender just to clear some things up, just to make sure that what I'm telling you is at least accurate to today's date, which as of the shooting of this video, Sunday, October 3rd. Okay, shall we move on? Let's move on. Okay, to get qualified for a mortgage, there are basically three main, headline or ticket items to get through that process. And that's what we're going to talk about today. And really the first one is credit score and credit history, although credit score I think reflects credit history, but really the credit score, there's a lower sort of limit. You can't be under a certain credit score and get a home loan. You would have to use some other means. I suppose you could try to get owner financing or something like that, but you wouldn't be able to get a traditional loan. Owner financing is also rather difficult to procure in this market. But nonetheless, to get a normal loan, a conventional loan, a VA loan, an FHA loan, all of those things have a minimum credit score. And a bit of a disclaimer, or perhaps some little piece of unity. I've had bad credit before, so I'm not going to judge you. I played in a touring band. I didn't make very much money at all. Let's be honest, I basically made no money. And with that said, the absolute minimum credit score basically that I've ever heard of that you can have to get qualified for any kind of traditional mortgage, I said it wrong, home loan, is 580. Okay, and 580 is qualified as not very good, right, as far as credit bureaus and stuff go. So that is going to be attached to a loan called an FHA loan more often than not. And an FHA loan has some pros and cons about it. We can talk about those in a little bit. But so the barrier of entry to get a loan to buy a home is a 580 credit score. So if you're under that, then you can just know, okay, I got to work on that. Also, quick note, how do you know what your credit score is? You could Google that. How do I find my credit score? There's going to be a ton of videos about it. First sort of option I would say is going to be something like a credit card. If you have a credit card company, a lot of times in the sort of phone apps, there's a sort of a portal to get a snapshot of your credit. If you don't have either of those, Credit Karma is a good resource. None of these things are going to be absolutely perfect, or they're not necessarily going to match up exactly to what a lender finds, but they are sort of a good guide, right? A good lighthouse or whatever. I just went to Iceland, so if I make a bunch of nautical references, that's why. And so FHA allows the lowest credit scores out of all the traditional loans, and that's really because FHA stands for Federal Housing Administration, and an FHA loan is a loan that is fundamentally insured by the government, the federal government, federal of F, and they want, these lenders to loan to more people because they want people to own homes. And it's a program to get more people into homes. So the government says to the investors who are going to be the ones giving you the loan and in turn taking that mortgage from you, they say, hey, investor, if you will lend money to these slightly more risky clients or buyers or whatever, we will insure that loan. As long as you follow these relatively strict guidelines, we will insure that loan. And that way, if you lend on that and this buyer defaults, then we, the federal government, will make you whole, basically, right? So it's a sort of government-backed loan. And yeah, there are some benefits to it, like pretty low down payment, 3.5% down payment. There are some cons to it. They're a little bit harder to get accepted. Actually, they're a lot harder to get accepted in a really strong seller's market. They have some more rules and restrictions as far as the condition of the home. That's a big one. If the home has something like peeled paint or anything like that, little stuff, no handrails, peeled paint, GFCI outlets, then sometimes an FHA appraiser is going to come in and flag those things, and ultimately the seller is going to have to do those things or whatever. So that is to say that if you have an FHA loan and you're going up against a conventional loan, that is a harder thing to, I don't know, get accepted. It's possible, but yeah, it's a little bit more challenging. So, but anyways, that is the absolute bottom, barrier to entry. Barrier to entry? We'll go with that. But if you have higher credit, that's great. You're going to get better rates. One loan, the loan that is more competitive versus FHA, would be called a conventional loan. And a conventional loan, to get into sort of conventional financing, you have to have a credit score of 640 or higher. And then from there, from 640 up, the higher you go, the better rates you're going to get, etc. And that said, just sort of like a big picture thing, not financial advice, not legal advice. If you have low credit, there might be, in theory, a reason to get into a house sooner rather than waiting until your credit is higher. And that would be basically appreciation. If you can get into a house now, if you just kind of eke by and just make it into that, home loan situation, it potentially could be smarter to get in now than, wait until your credit goes up by 50 points if it's going to be like a bit of like a long burn. If it's going to take you a whole year, it might make sense to just get into one with an FHA loan, if you can, versus waiting and making that credit get higher and higher. Just food for thought. And then one last little bit on the credit piece is that we work with really incredible lenders whom we trust very, very much. And if you were to reach out to us, we'd put you in contact with a lender, and they would be able to look at your financial picture and give you a very clear roadmap to what you have to do to get a loan. If your credit is low, they can simulate things and say, okay, if you do X, Y, Z, that will bring your credit up to an acceptable place. So something to consider. If you reach out to us, even if your credit's too low, it's all good. We'll still put you in contact with them, and they'll be able to work with you on that. So you're not just shooting in the dark watching other YouTube videos trying to figure out how to get your credit higher. They'll do a much better job, a much more precise look into your financial picture to figure out what it is that you should do to bump that credit up. Okay, and then the second piece to getting a loan, and I don't know, maybe I should have started with this one, whatever. It's job history. Basically, how long have you been doing the work you've been doing? How long have you been employed? That gets a little bit chewy, but we'll get into it. So one very, very fundamental rule of thumb, the easiest way to be like, you're all good here, is if you've worked the same exact job for 2 years or more. Doesn't matter what that job is. If you've worked that job for 2 years or more, then they'll probably be thrilled to give you a loan. It'll be much less tricky. That said, not many people do that, or a lot of people have transition jobs, or they started at one job in the company, went over to another job in the company. A lot of the time, that's going to be just fine. You've worked in the same company, you've maybe gotten a promotion, something like that. I believe pretty much all the time, the lender's going to be like, that's great, good for you, you got a raise. You're not going to get penalized from getting a raise. One thing that might be a deal breaker is if you've gone from one industry totally to another. And not a deal breaker in the sense that like you have to wait a full 2 years, but you may have to wait 6 months. So if you've changed industries, then potentially they're going to require you to have worked there for 6 months. They're going to need pay stubs that prove, okay, this job is like permanent and you're going to be able to continue to work there. But that said, if you're working in the same industry but different companies, and I think that can be pretty vague, right? Let's say you're a construction worker. I think if you worked in concrete versus electric, don't quote me on this, but I tend to think that you could say construction or trades, and that would be fine. I guess maybe if you worked in a hotel and then a restaurant, potentially that could be all qualified as hospitality. I'm not totally sure about that, but I do understand that those sort of moves, as long as they're generally within the same world, can go over really well with a lender. So something to consider, and definitely something that if you have that question, just reach out to us, we'll let you talk to the lender, and they'll clear that up for you very, very well. And then one caveat to this is that sometimes like university level schooling, or I suppose potentially like a trade school, can also count as work history. I don't think that's true all the time, but I know that I helped a guy who worked in computer software, and he was a young fella, and he did not work in that field for a full 2 years, but he had gone to school for 4 years right before that, and he just got himself into a house. So for sure, sometimes schooling does count. I don't think, for example, realtors, we take classes to become licensed in real estate, and I don't think that something like that would qualify as education. For one, it's not as long, but I don't know. I still don't think that it would count. I still think they'd want more actual employment as far as something like that goes. But I do believe something like training would also help, right? So if you were a flight attendant and went to flight attendant training, which I understand takes a really long time. I don't know. I had a flight attendant who was a client, and he said that it took a long time. It was pretty grueling, classes or training or whatever to make it. And in that situation, I believe probably because you'd be paid, I believe that then that would be fine. That would work as employment history. And then one final little piece, if you are self-employed, it gets more complicated. It's not impossible to do at all, but it is considerably more complicated. So while I wouldn't say, you should steer away from it because of that, I would say be prepared to have to provide more documents and be a little bit more thorough during the underwriting process. Don't get mad at the processors for asking for a bunch of documents. They're just trying to make sure that you are in fact legally allowed to get a loan. Because you remember 2008? That wasn't cool, right? Have you seen The Big Short? Good movie. Such a good movie. Okay. Anyways, that is the second sort of piece, and the final piece, and this is definitely the biggest, the most chewy, and I apologize for all the jargon I'm about to throw out, but it's debt to income ratio. Your debt to income ratio is a huge factor. You could have immaculate credit, you could have worked at the same job for 10 years, but if your debt to income ratio is out of whack, then it doesn't matter. You're not going to be able to get a traditional loan. So this is a very important piece. And to illustrate it, I'm going to have to give some general numbers. I don't want to just say debt to income ratio, figure that out, and that's the last piece. I'd like to be a little more educational than that and give you a look into how do you calculate your debt to income ratio. Before I dive into the actual example, I'm going to go on a little bit of a tangent and sort of explain the boxes that are the debt to income ratios with different loans. For the most part, the most common debt to income ratio that is allowed is 45%. Let me quickly define what debt to income ratio is. It's maybe a little obvious, so I apologize if you're like, no, duh. Okay, so I apologize. But some people are probably like, I don't understand. What is that ratio? Basically, you're taking your gross, right? Gross being before taxes. So all the money that you make from your job before taxes and probably insurance-y type stuff is taken out. And you take that gross payment and you compare that to how much your minimum debt obligation is on all of your debts, right? So if it's school loans, if it's a car loan, if it's a credit card, if it's if it's revolving credit or whatever, they take all of what you have to pay per month, so your minimum monthly obligation on your debt, and they compare that to your income. Hopefully, your income is bigger than your debt obligation. Otherwise, you're just going to keep racking up more debt because you won't be able to pay it, right? So certainly in order to get a home loan, your income has to be way higher than your debt. And very specifically, 45% of your total income can be dedicated to monthly debt. So I suppose it's something more like this. If this is all your income, then something like this can be your monthly debt obligation, right? So I'll dive into that a little bit more. So again, your gross income versus what your minimum monthly obligation to all of your debts are. And that includes the mortgage, right? So that includes the loan that you're paying on. That's something a lot of people don't understand, right? So it includes your mortgage. That's something some people don't understand. So let's dive into this tangent real quick. There are basically three different types of loans in a sort of traditional sense. There is a conforming, which is under $548,250. Okay, anything under that is considered a conforming loan. Okay, anything between $548,000 and $250,000. Wait. Anything between $548,250 and $596,850. I'm definitely reading that, just so you know. Anything between there is considered a high balance loan. Okay, so it's still sort of conforming but higher balance. And then anything above that number, $596,850, anything higher than that is considered a jumbo loan, which is important for a few reasons. For one, in Denver, a lot of the homes here are in the jumbo loan territory. There's a lot of homes, over $600,000 here. And so that's important to know that you'd be in jumbo loan territory. And the loan, that's the loaned amount. That's not the price of the home. If you did 80% down on $1 million home, well, you'd only be financing $200,000. So even though it's $1 million home, it's not a jumbo loan. The loan has to be over that $596,850 to be considered a jumbo loan. So the reason that I think I bring that up, for one, the debt to income ratio, the maximum debt to income ratio on a jumbo loan is slightly lower than everything else. It's 43%. So 43% of all the income you make can be dedicated to a jumbo loan. Okay, so it's a little bit tighter, I guess, as far as what is allowed. But jumbo loans typically in this market, okay, this is not going to last forever. I'm sure this will change over time. But right now, again, as of the making of this video, Sunday, October 3rd, 2021, jumbo loans have better rates a lot of the time. So very often in this market, we're sitting around rates of 3 1/8, or it's like 3.125, and 3 1/4, 3.25 for traditional, conforming loans, right? So basically loans under that $496,850, right? So anything under the jumbo loan, you're going to get 3 1/8 or 3 1/4, somewhere in that ballpark. But if you're in a jumbo loan, you could get potentially 2 7/8 is what they're seeing a bunch right now. So it's potentially a 1/4 to 3/8 lower interest rate, which if you're like somewhere on the cusp of, depending on how much down payment you put in, or depending on how expensive of a home you buy, if you're close to that jumbo loan territory, it might make more sense to just eke right over that line. You'd be getting a better rate. This is stuff that the lender's going to tell you for sure. Like, they're awesome at what they do. They're going to tell you that. But I guess just from your information, if you're thinking, you've probably been looking at houses or whatever on Zillow, calculating some stuff. If you're somewhere close to financing that $600K mark, then yeah, you might want to rethink, rather than, 20% down or whatever. You might want to make it so that your loan is a little bit higher. Again, not financial advice, talk to a lender, but I think that's important to know. So it depends on the loan type, what the maximum debt to income ratio is. Again, jumbo is 43. Some VA loans go up to 50% debt to income ratio. Super depends. Some FHA loans, very specific situations, will go up to 48%. But the most common number for that is going to be basically 45%, right? So write that down. Feel free to write that down. 45% maximum debt to income ratio allowed. And then I'm going to kind of show you how to calculate that. Okay. Maybe you want a pen and paper, pencil and paper, whatever. Hopefully this simplifies it and you can figure it out for yourself approximately what your current debt to income ratio is, and then what would they allow your payments to be. Okay, so since the income of debt to income is gross income, and specifically gross monthly income, I'm going to use the median household income of Denver. I don't think that is exactly related to like people who actually own the homes, but median household income of Denver is $72,000. Okay, and I think that's whether it's one income earner versus two, it doesn't matter. The median household income in Denver is $72,000. And this makes it easier to calculate actually, that it's like $72,000, because we're actually looking for the gross monthly income. And the gross monthly income of $72,000 annually is $6,000, like a nice easy round number. $6,000 per month gross is the median income in Denver. So write down your monthly gross income. Okay, that's going to be one very, very important piece of this. Okay, so for my example, I'm using $72,000 annually, $6,000 monthly, and now I'm going to take 45% of that. You can go times 0.45, you can go divided by 45% equals, and then in my example, that number comes to an even $2,700. Okay. So, what does $2,700 mean? That basically means that more or less, again, some exceptions, I'm sorry for overqualifying, but $2,700 is sort of your allowance of total debt, right? So what does that mean? That means $2,700 is your total sort of allowance for debt while including the home loan within that debt, right? So your monthly service of all of your debts, your minimum monthly service, including your mortgage, in this example, cannot be more than $2,700. If you make more than that, whatever that times 0.45 or 45% of your gross income, that number is going to be your monthly total allowance. So $2,700, and that's including all of your debts. So, for example, let's say that you have 2 car loans, okay? I'm going to say, let's say you're a 2-income household, it's 2 people, you make the median income of all of Denver, and you have 2 car loans that are $300 each, just to make it easy. And that's a total of $600 in debt that you are required to pay on every month. And so then you take that $600 number and you subtract it from that $2,700 number. In that case, it's $2,100. In this video, I'm just going to say that that's it. That's all the debt you have. I've helped plenty of people where they have less than $600 in monthly debt. I've helped people with more. I've helped people who make a lot more, so they have a lot more debt. But you're taking that 45% number, you're subtracting all of your debts. And for the record, insurance, utilities, that kind of stuff, that's not debt. That's just payment. That's just stuff that you have to pay. That is not debt. That does not count. So only things that you have taken out a loan on fundamentally, and that includes credit cards, school loans, auto loans, I suppose other household loans, that kind of thing. Those things are what you're subtracting, right? So again, $2,100 is your 45% of your gross income minus your debts, $2,100. And then that part, that is really what is your monthly budget for the home, right? Whatever that number is for you, that is what approximately what the bank will lend to you based on. Whatever that number is for you, that is what the bank will lend to you based on. They calculate it that way. So that's going to say based on that $2,100 allowance and whatever down payment you have, what will that look like? So they're going to reverse engineer that based on that $2,100 allowance and whatever down payment amount you have, then what can the total purchase price be of the loan? And you can use Realtor.com or Zillow. I think they have a calculator, or you can just go online and look up a mortgage calculator. Make sure it's PITI for the record, principal, interest, tax, insurance. You also have to count any HOA fees. Okay, so rewind that if you have to. Principal, interest, tax, insurance, PITI, plus any HOA fees. That is all considered part of your monthly payment. Okay, and then just super ballparky here, okay? If you have an identical financial situation to the example, $72,000 annual gross income, approximately $600 in debts that you have to service every month, $2,100 allowance, then that could... So if you have an identical financial situation to the example. $72,000 gross annual income, approximately $600 monthly minimum obligation to all of your current debts, and then let's say you have $40,000 for down payment, okay? Again, all this stuff shifts, and this is really where the calculator comes in. I just used a generic calculator for this. It depends on so many things. It depends on the insurance cost of the home. It depends on the insurance cost of the home. It depends on if there's an HOA. It depends on the taxes. There's a bunch of variables. I wanted to use something that you could use just at home to kind of have a rough idea of it. So I use Realtor.com. I just found a house kind of in this ballpark. You can change the number. You can change the down payment. You can change the interest rate. I think I used 3.25 just to be conservative, as that's kind of what the lender told me they're looking at today. And that budget, that sort of debt to income ratio situation, allows you total purchase price of around $400,000 with 10% down. Okay? And it may be a little bit higher, maybe a little bit lower, depending on the taxes, but ballpark, that's what that's looking like. That was a lot of information. And so maybe you watch that video and you're super disheartened and you're like, well, I don't make that much money and I have more debt. Unfortunately, the only things that you can really do to sort of improve that situation is make more money, so have more income, or pay off your debts. If you have debt to pay off, don't just pay it off willy-nilly. Talk to a lender to figure out which one is going to be the most effective. Not all debts are going to be the same. If you have a credit card that has a minimum monthly obligation of $100, or you have a car payment and you could pay equal money. Let's say you have $2,000 left on your car payment, $2,000 left on that credit card. It could be smarter to pay off the car payment rather than the credit card, because that minimum obligation is $300 per month versus $100 or something on the credit card situation. Again, I don't know that that's true, but that's why you should reach out to us. We'll get you in touch with a lender and basically make that crystal clear. Here's what you should do as far as what you should pay off. They can give you crystal clear path. Here's what you should do to get your credit up. And they might even tell you, don't get this job yet, or something like that. If you want a home in the next 6 months, don't get that job or something. And they might even give you some clarity in what you should do as far as like taking a new position or, quitting your job. Certainly don't quit your job right before you're trying to get a house. Not a good idea. But again, these are all very, very generic numbers. I implore you to reach out to us and we will get you in touch with an amazing lender, truly amazing lender. And you can get a hold of us any way you can. Welcome to Denver.co is our website. You can call or text the number on the screen, or you can email us at info@welcometodenver.co, not .com, .co, as in Colorado, as in your new home soon. Appreciate y'all watching this. As always, as you exit the video, do so safely. If you have not done so yet, subscribe to the channel, click that bell to get notified, give the video a thumbs up, say what's up in the comments. I appreciate it very much. It helps the channel. It helps us help people. Help me help you. Jerry McGuire, take it easy. I'll see you in the next one. Can't wait to meet you. We did it. Let's go.